The financial market is many things, but it is foremost a giant mirror of the world. Wall Street loves good stories and rewards those who figure out the plot before everyone else. Gold has been the best performing safe haven asset since the start of this decade. What does it say about the power struggle between the unipolar and the multipolar world? Who's buying gold? Why are they buying it? Is it sustainable? Should you be buying it too?
Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. The world produced 4,750 tons of gold in 2022. That is about $300 billion worth of gold at today's gold price. Though gold production from mining increased by 1% last year, interestingly, it is still below the record set in 2018. About 1/3 of the world's gold production in 2022 came from just 3 countries: China, Russia, and Australia. China is the biggest gold producer in the world. Chinese production grew 13% last year as mining in Shandong province returned to normal following safety stoppages for most of 2021. Russia is the world's second largest gold producer. Russian production fell 8% last year as the result of the war in Ukraine. Gold production in Australia, the third biggest gold producer, ticked up 1.5% in 2022. The market share of South Africa, which was once the world's biggest gold producer, fell to just 4% due to strike action and electricity supply issues. Some commentators believe that gold supply has peaked. Whether this will turn out to be true or not, what really stands out in the data is the incredible stability of gold production for most of the past 10 years. Indeed, even the massive rally in gold price over the past few years has failed to lift gold production. Despite the fact that gold outperformed stocks, bonds, and cash in 2022, gold production fell in the final quarter of last year. But the slow growth of gold production does not necessarily mean that the world is running out of gold. What it does imply is that the marginal cost of mining gold is going up as gold reserves that are easy to access are dwindling. Between 2008 and 2022, the cost of mining gold for Agnico Eagle mines, one of the largest gold mines in the world, has gone from $162 an ounce to $793 an ounce. That's an annualized increase of 14%. The steadily rising cost of gold mining should be viewed as a major support for gold prices. On the demand side, jewelry demand, which accounts for more than 40% of gold demand, was largely unchanged in 2022 after a robust recovery in 2021. However, the surge in gold prices since late last year has recently dampened jewelry demand in India, the biggest importer of gold in the world. Indeed, Indian gold demand fell by 17% year-on-year in the first quarter of 2023 compared to 2022. While the global jewelry demand for gold exhibits a fairly pronounced cyclical pattern, meaning that it is positively correlated with economic and income growth, it's been quite stable over the past decade, averaging about 2,100 tons a year. What about investment demand for gold? It grew 10% to reach 1,100 tons in 2022. It is interesting that this was driven by an increase in demand for physical gold, coins and bars, as opposed to gold exchange-traded funds that fell for the second consecutive year. Turkey and Middle East account for much of the increased demand for gold bars and coins. In the case of Turkey, double-digit inflation in a collapsing lira boosted demand for gold. Turkey, along with UAE and China, have become the main destination of Russian gold exports since the war. But the big story of last year was the surge in central bank demand for gold. Huge central bank demand in the second half of last year took annual buying in the sector to a high of 1,136 tons that exceeded non-central bank investment demand for the first time in recent decades. A report by the International Monetary Fund, published in January, identified 14 active diversifiers, defined as countries that purchase gold and raise its share in total reserve by at least 5 percentage points over the last 2 decades. The report showed that active diversifiers into gold are all developing countries. The paper documented 2 sets of factors contributing to this trend. First, gold appeals to central bank reserve managers as a safe haven in periods of economic, financial, and geopolitical volatility, especially when the return on alternative financial assets is low. Second, the imposition of financial sanctions by the West, the main reserve issuing economies, is associated with an increase in the share of central bank reserves held in the form of gold. The latter factor was clearly the key driver of the surge in gold demand by central banks in 2022, following the imposition by the West of unprecedented financial sanctions against Russia. Is this trend going to continue? A recent survey conducted by the World Gold Council found that 25% of its central bank respondents expect the level of gold reserves in their institution to increase over the next year. While the survey found that central banks' views toward the future role of the US dollar are more pessimistic than in previous surveys, their views towards gold's future role is more optimistic. Indeed, 62% of central bank respondents said that gold will have a greater share of total reserves compared to just 46% last year. The World Gold Council estimates that around 209,000 tons of gold have been mined throughout history, of which around 2/3 have been mined since 1950. This means that the total stock of gold is currently increasing at a rate that's below 2% a year. Compared with fiat money that has grown nearly 50% just over the past 5 years, this is a very slow rate of growth. Even though gold, unlike bonds and stocks, does not pay interest or dividends, the fact that gold supply is growing more slowly than fiat money has been its main attraction for gold bugs, who see gold as the ultimate hedge against policy excess. There are 4 key drivers of the demand for gold. 1, real interest rates. 2, the US dollar. 3, growth of financial assets. 4, geopolitical risk. Let's examine each of them in turn. If gold is an inflation hedge, then its price should be correlated with other assets that provide inflation protection. Inflation index bonds are such an asset. These bonds allow investors to lock in real inflation-adjusted returns. Because gold pays no interest, nominal or real, gold price should be negatively correlated with the real yields on inflation index bonds. As you can see on this chart, this has been the case for much of the past decade. When real yields go up, in other words, when monetary policy tightens, gold price usually goes down. When real yields go down, in other words, when monetary policy loosens, gold price usually goes up. Between August and September last year, as real yields on 10-year US inflation index bonds skyrocketed, gold price dropped sharply. Historically, the second most important driver of gold price has been the US dollar. The reason is simple. Gold is priced in US dollars. So when the US dollar goes down, the purchasing power of the rest of the world for gold goes up, and gold price goes up. Conversely, when the US dollar goes up, the purchasing power of the rest of the world for gold goes down, so gold price goes down. By the way, this is true for any commodity priced in US dollars. As you can see on this chart, gold price sported a negative relationship with the dollar over the past year. Gold price peaked in March 2022, just when the dollar began to take off. Then gold kept falling as the dollar surged towards its all-time high. However, as soon as the dollar rally lost steam, gold came storming back. The third driver of gold is the growth of financial assets. Let's assume that gold has a unique place in every investment portfolio that cannot be replaced. In other words, let's assume that there are no perfect substitutes for gold. What this means is that big or small, gold will always be a part of any portfolio. It follows that gold price should keep pace with the growth of financial assets. As you can see on this chart, gold price has been trending higher with US financial assets over time. The correction in gold in the middle of last year was consistent with the decline in US financial assets brought about by declines in both stocks and bond prices. The fourth driver of gold is geopolitical risk. Geopolitical risk covers a wide range of risks. For millennia, gold was the only way refugees could flee with their savings, as gold was relatively easy to carry and hide from invading armies. For millennia, wars have boosted the demand for gold. But there are wars and there are wars. The Ukraine war is not just any war. It is possibly the most important war the world has seen since the Second World War. I've argued in other videos that the war in Ukraine is a proxy war between the United States and Russia, a war between globalism and nationalism, a war between the US-led unipolar world and a multipolar world led by China and Russia. Because the US has decided to weaponize the dollar's global dominance to achieve its war aims, and because the war is slowly splitting the world into two opposing camps, it is no surprise that demand for gold, especially by governments, in other words, central banks, is going up. For the past 6 months, the Chinese central bank has been buying gold every month. It raised its gold holdings by 8 tons in April alone. This is not the first time that China has boosted its gold reserves, but this is the first time that it is buying gold when its foreign reserves are not going up. In other words, it is selling its other holdings to buy gold. With China still holding $800 billion of US government bonds, and likely other forms of US assets, it is reasonable to assume that it's got a long way to go before it hits the desired allocation of gold in its reserve portfolio. However, given that liquidity in gold is limited, China and other central banks cannot achieve their desired gold allocation overnight. They will be nibbling as opposed to chasing the price. They will be buying, especially on pullback. In most of my professional career on Wall Street, I have never been much of a believer in gold. However, the Ukraine war has changed my mind. To the extent that I think the power struggle between the unipolar and the multipolar world is here to stay, and more likely than not to intensify in the coming years. I cannot think of any other safe haven assets that can challenge gold's unique quality. Moreover, the US debt ceiling crisis and the decision by the Bank of Japan to take its time to normalize interest rates are all telling me that we have reached a point of no return, that governments will not be able to wean themselves off their debt addiction. This means inflating away debt becomes the only policy choice. Unfortunately, the stock of debt will keep growing and real interest rates will be kept low to keep the party going. While I don't see any other currency in a position to challenge the dollar's global reserve currency status in the foreseeable future, I think gold is the most obvious beneficiary of diversification out of the US dollar. If you got something out of this video, please hit like and subscribe to my free YouTube channel. Let me know what you think by posting your comments in the video. If you want to learn more about my investment strategy, come check us out at davidwuunbound.com. Thank you for listening.